From 2015 to 2020, Tata Motors was a textbook value trap. The domestic passenger business was bleeding cash. The acquisition of JLR looked structurally broken, and institutional investors were quietly walking away. Fast forward to present, Tata Motors PV has pulled off a historic turnaround selling, securing number 2 market positions in the domestic sales. Same company, a complete different story. So the question I want to walk through with you today is this. What actually changed and what could the next 3 years look like? We are going through this methodically with the numbers and with the risks because in my view the risks matter just as much as the opportunity. Before we look at where this company is going, we need to understand one structural change that happened in October 2025. Because without it, we are reading the wrong company. For years, passenger vehicles, commercial vehicles, and Jaguar Land Rover all sat under one roof. One company, 3 different businesses. In August 2024, the board approved separation of passenger vehicle business, including EVs and Jaguar Land Rover, from the commercial vehicle operations into 2 different listed entities. And on October 1st, 2025, it became legally effective. Share swap, 1 for 1. Every existing shareholder received 1 share of the new commercial vehicle entity as well. Now, why does this matter to how you read this stock? It is a pure play PV and EV company, valued entirely on its own merits. Secondly, management focus and capital undivided. Third, JLR's performance now sits completely exposed in the numbers. And the point is one that changes everything. JLR contributes approximately to 87 to 90% of Tata Motors PV consolidated revenues. JLR is not just a subsidiary now for this company. JLR is the engine room. Which means everything we look at in this video, every number, every opportunity, every risk flows back to one question: how is JLR performing? We will get there, but first the domestic business, because the story there is one worth understanding on its own. FY26 was Tata Motors' 5th consecutive year of record sales, and for the first time they surpassed Hyundai Motors India. This is not just a small milestone. Now let's look at what drove it. In Q4 FY26, company sold 2,01,800 units, up 37% year on year, aided by strong demand, GST 2.0 led industry recovery and traction across recent launches including Sierra and refreshed portfolio. FY26 CNG sales crossed 1.7 lakh units, registering 24% year on year growth. Exports and international sales crossed 10,000 units during FY26, supported by company's re-entry into South Africa. Tata Motors records its highest ever annual EV sales of 92,120 units, up 43% year on year, while cumulative EV volumes crossed the 2 lakh unit milestone. On a standalone basis, India domestic PV plus EV revenue for FY26 was 58,465 crores, up 21% year on year. EBITDA margin remains similar at 6.90% due to double pressure from commodity inflation and an intensity competitive pricing environment. Over the past 5 years, the company's revenue has compounded at a growth rate of 11%, while it has turned from a big loss-making entity to a profitable one at least. Now, let's come to what company calls as the powertrain strategy. Here is something that is underappreciated in most coverage of this company. While the industry was debating EV versus petrol, Tata made a different call entirely. They chose to build credibility across all the platforms at the same time: petrol, CNG and electric. The CNG and EV combination already accounts for 41% of the total volumes, the highest green powertrain share among domestic PV OEMs. This is structural moat, which isn't easy to replicate, making Tata Motors is the only Indian OEM with deep credibility in both CNG and EV. Now let me run through the key models quickly, because volume is the ultimately driven by what is sitting on the showroom floor. First, we have Nexon, the franchisee model. It is India's #1 selling passenger vehicle in H2 FY26. The Nexon EV is India's first domestically produced EV to cross 1 lakh plus cumulative sales. Number 2, we have the volume driver called Punch. It is India's #3 selling PV model in H2 FY26. The Punch EV launched at Rs 9.99 lakh. It was launched in January 2024. That price point was critical in bringing EVs within reach of mainstream buyers. Harrier.EV, the premium EV flagship. The Harrier.EV launched June 2025. 65 kilowatt battery, claim range of 538 kilometers, its AWB variant was priced at 26.49 lakh. This is Tata signaling serious intent in the premium electric space as well. And the Sierra, the revival, one of the most anticipated relaunches in the recent Indian automotive history. Over 1 lakh bookings, more than 23,000 units were delivered in FY26. The Sierra EV arrives in Q2 FY27. Now, let us come to the JLR business. I want to spend proper time here because this is the section that arguably defines the investment case more than anything else. Nearly 9 out of every 10 rupees of revenue this company reports comes from JLR. That makes JLR's performance not a side note, it is the central chapter. FY26 was a challenging year for JLR, and I think it's important to be clear-eyed about that. Let us understand the challenges faced by the JLR business. It had cyber attacked. A significant cyber incident disrupted JLR's production and supply chain operations during the financial year 26. Second challenge was facing by the China market. Historically, China market was JLR's second largest market. It faced continuous weakness. Third, US tariff shocks. JLR faced significant margin pressure on its US exports. Number 4, the final Middle East disruptions. The West Asia conflict temporarily disrupted demand and supply in Middle East nations, approximately 6% of JLR sales, with input cost pressures from freight and petrochemicals. Now, what does recovery look like? Management has already laid out recovery plans for JLR. Cyber recovery is completed. Margins expected to improve in financial year 27 and financial year 28. Free cash flow expected positive in FY27. New EV launches to improve the product mix. However, do note this, these are the management's expectations and not the real outcomes. Now, at the next 3 years, here are the 5 things that will define where is this company goes. Number 1, Avinya. It is a Tata's most ambitious branding move. A premium EV tier positioned above their core Tata EV lineup. What makes it technically meaningful is the platform. Avinya will share JLR's electric modular architecture. This is a significant technology transfer that took years and substantial investment to build. Number 2, Panapakam plant in Tamil Nadu. It's India's PV market is targeting 7 to 8 million units annually by FY30. Tata, aiming for 18 to 20% market share, needs to produce 1.4 to 1.6 million units per year. Today's combined capacity is approximately 700 to 800,000. Panapakam starts bridging that gap. Number 3 is the battery cell manufacturing. Vertical integration in batteries means less dependence on imports and long-term structural implication for the cost. Number 4, that is JLR margin recovery. This one is simple. JLR's margin are the lever. Watch it every quarter. For number 5, EV market share defense. Tata builds its EV position through years of early investment. The market is now more competitive than ever. Execution on new launches and pricing discipline will determine whether that leads hold or not. And to give you a sense, FY27 alone is one of the most product intensive years in the company's history, with launch of various models including Sierra EV, Safari EV, Avinya X, Scarlett, Tiago Tigor, new variants. Now coming to at risks. What are the risks? Number 1, JLR concentration, 90% of the revenue from one entity. Any JLR headwind hits the consolidated numbers directly. Second risk is the EV market share. More competitive landscape due to various players like Mahindra, MG Hector. Their first mover advantage is not going to be forever. How they defend this space from the competitors is something to look forward to. Third risk comes from currency and geopolitical risks. JLR manufactures in the UK. GBP, that is pound, movements impact reported numbers. Number 4 risk is execution. Delay in launches can affect the market share significantly. Number 5 is the input cost inflation. Steel, copper and aluminum, which are the raw materials, were significantly up in FY26. Sustained inflation compresses the margins. These are not the reasons to form a view in any direction. They are simply the variables that any clear-eyed observer of this company needs to keep in the radar. So let me bring this together. Few years ago, Tata Motors was a value trap, but in 2026, their domestic business outsold Hyundai Motors India. Their EV division crossed 2 lakh cumulative sales, and JLR going through most consequential technological transition. 3 storylines, 1 company running simultaneously. The October 2025 demerger was a statement that this business is confident enough in its own story to stand completely on its own and be measured entirely on its own merits. Before we end this video, let me ask you a question. What do you think will be the biggest changer for this company over the next 3 years? This video is for information only and not recommendation to buy or sell any stock. For more such content, follow Equitymaster for more.